Hello and welcome to episode 235 of the Money to the Masses podcast with your resident expert as always, Damien Fay and me, Andy Leaks. Damien, how you doing?
I'm good. It's good to be back on the show. It's been, I won't mention the football. We won't do football much this week other than just to laugh at Andy's expense. It's a very confident prediction last week of Watford's first win of the season. I mean, what went wrong, Andy?
Well, do you know what? I'm glad I'm not a betting man anymore. That would have been what you would call a home banker. if you've ever heard of the phrase home banker, you would look across the football calendar and you go, Watford on form against Brighton at home, and it all went wrong. We lost 3-0 to those of you who don't know, and I'm pretty depressed about the future for Watford Football Club.
Well, I mean, Spurs won, and we eventually won. And it's the only good thing about the football that I really enjoyed, obviously, was the win. But I took my eldest it's not the first time I've taken her to football, but it was one of the first times. So that was good. But, I suppose we should talk about money stuff. Oh, before we do that, a really exciting announcement. Now, we do the Facebook stuff, don't we, on a Monday? We're not going to do it next week, because I do a bit of admin, actually, before the exciting announcement. There'll be no podcast next week. So Andy and I are taking what I'd like to think is a well-earned rest from Money to Masses for a week to spend time with our respective families. We're not together. We're not like Ant and Dec. We don't do everything together. So we're taking a well-earned rest for 1 week, but then we are back as normal the following week. So the bank holiday weekend, you won't have a podcast, but after that, we're back as normal. Now, of course, that does mean there won't be a Facebook group on the Monday, but it'll be back in future. Now, the exciting announcement, on the 24th of September, we are doing our first ever Money to the Masses event, which will be exciting. It's going to be at the General Assembly in London. Now, it's a free event, and the title of the event is Build a Champagne Lifestyle on a Lemonade Budget. And what that means is the event is going to be a panel discussion with me on it, and we will reveal the other panelists as the weeks go by. It's on the 24th of September, as I said, between 6:30 and 7:30 p.m. In central London. Now, it's going to be an event that's hopefully sell out, even though it's free, very quickly. So put it in your diary. If you want more details and if you want to register, you can do that if you go to moneytothemasses.com/events. Andy will put a link to the relevant site. And as I said, it's an exciting thing. We've never done it. It's the first one we're going to do. So please, 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 if you listen to this podcast and you like what we do, come along and support us, but you're going to learn a hell of a lot. We've got some really good panelists, and we're going to talk about everything from investing to savings to budgeting to getting your first house, whatever it is. There's no age range. This is for everybody. So please, please support it. You've all asked for things like this, and now we are finally doing it.
Do you know what, Damien? And as an ambassador for podcasts, I love podcasts. I listen to podcasts. There are loads of people doing events at the moment, live events. Come and see us live. But they're all charging money. And this is where we're unique. We are not charging money. We want people to come along and enjoy meeting us, learning something new, and you can do it for free. I mean, how good is that?
That is good. To back up what Andy's saying, there is an event I'm doing for somebody else, a panel discussion I've been invited on the week or so before that one. I'll release some details, but I think it's actually sold out. That is an event that is charged. It's £25 a ticket. It's not our event. It's a separate event by Good Housekeeping and Red Magazine. So it's aimed at a more female audience, but it can be men as well, can come along. And I'm on that panel, but it's a charged event. So we're doing an event. It's for free. It's for everybody. Please come along and support it.
Good. So that's the admin out of the way. What have we got coming up on this week's pod?
On this week's podcast, we have got 3 pieces as usual. Now I'm going to talk about private health insurance. So it's something we've not done before. We've been writing about it a hell of a lot on the site. In fact, Andy, as our resident insurance expert, has been writing a lot about it. So we're going to cover private health insurance, this kind of what, the how, what to buy, the costs, give you a whistle-stop tour, because there are a lot of people out there who may, for whatever reason, be disillusioned with the NHS or just want to have an ability to skip the queue or want to know a little bit more about how that health insurance works. I'm going to give you that and the pros and cons. Then we're going to have an investment piece on Brexit. The second, or so should I say the last 2/3 of the podcast, we've got a slight divorce feel to them, which is slightly sad, but Brexit, us getting divorced from the European Union. I'm going to do a Brexit playbook. So I get asked a lot about what investments will do well, what to hold, what not to hold in the case of a no-deal Brexit. Now, we don't know if a no-deal Brexit is going to happen, but by all accounts, we're heading that way at the end of October. So I'm going to give you an overview of some of the investments and how they might perform. And the way I find out how you look at that, and is to go back and look at a particular moment in history to see how investments performed around then. But I'll explain more later in the show. And finally, we're going to do a piece on divorce again, but with children's savings. So I had a question from somebody I knew personally about what to do with some savings they had earmarked for their children when he and his wife were then going to go through a divorce and separate. And how could they ensure that the money went to their child because it was in a savings account? So what to do with savings in the event of you splitting from your partner to ensure a child still benefits from it and the ex-partner can't run off with the money. So there we go.
Good stuff. So what are we going to start with?
So private health insurance, sometimes called private medical insurance, PMI if you work in the industry. If you ever see that abbreviation, it does mean private health insurance or private medical insurance. Now, as I said in the intro, there are a lot of people who might be intrigued about it but never bought it or don't know how it works. So what is private health insurance? In simple terms, it's a health insurance policy. So it's an insurance policy which basically pays out in the event that you need some medical treatment of some kind. Now, to give you an example, we've got the NHS, of course, but to give you an example, it may be that you have insurance that will allow you to get quick access to medical treatment, quicker than you could get on the NHS. It could allow you to choose where you are treated, a little bit more control over the timings of your treatment, and it may even allow you to get access to treatment or drugs that aren't on the NHS. So they're all positives of the private medical insurance. So I'll come on to the cons in a minute. So typically on the insurance policy, what they might pay out for, you pay a monthly premium, and if you make a claim, then they might pay out for something like a hospital stay. They may pay out for nursing care, outpatient treatment, medication. Additional cover can be added, but it normally varies by policy to policy. Now, one thing to bear in mind about private health insurance as an industry, it is quite nuanced. Every policy seems to be different. Different insurers have different T's and C's, so you have to check them all, which is why I think a lot of people become slightly disillusioned or confused and then just give up on the whole thing. In fact, I think most people who have private health insurance probably have it through their employer. Now, I know historically, the only times I've had it is when it was a benefit through somewhere where I work. And I've not had it since, partly because I thought of the expense, but it isn't always as expensive as you think, so I'll come on to. So private health insurance, it's a policy that can pay out for you or whoever's, that may be your family members as well. What's not covered is pre-existing medical conditions. Now, typically something that's chronic. So if you've got a chronic condition now, I'm always giving myself as examples on these things, like my chronic, my chronic Crohn's. It's got is it alliteration? Chronic Crohn's? I wouldn't necessarily be covered on that because you've got to realise that I'm a bit of a drain on the NHS, not through choice, but I am. So therefore, if an insurance company was going to start covering that treatment and paying for that through an insurance policy, they'd be paying out a lot of money and my premiums would be enormous. So chronic conditions aren't usually covered. I mean, well, it's not condition. I always find this funny that the insurance companies use the word condition, but pregnancy, it's not a condition. It's a sort of state, but that's not covered, or drug abuse, things like that. They're not typically covered in those insurance policies. Now, longer term conditions as well often aren't covered. Now, they can be because of a type of underwriting that they use. So underwriting is when you go to have a policy, they look at the risks and then they decide whether to accept you in the type of policy you'll have. And there's something I'll come on to called moratorium underwriting later on that will enable some of your pre-existing medical conditions to be included. To give a brief overview, because like I said, there's so many types of private medical insurance. There are three broad types. So there is basic, which is something you would call treatment only cover. Intermediate cover, which is treatment but limited diagnostics. So they might diagnose you, some x-rays might be included, or consultations, but limited amounts. And then there's the sort of fully comprehensive cover, which is a full cover which will cover diagnostics and obviously treatment. So
that's the whistles and bells and everything. You probably get your own room and flowers in the room and all that.
You get everything, and that's the one that will be more expensive. So those 3 tiers, they're 3 tiers that, to be fair, Andy really pulled up when he was doing the analysis of all this stuff. They won't necessarily call them that with each different insurer.
That's right. That's what is so frustrating about these. When you're researching these things, you think you want to compare things and be able to come up with a concise article that looks and compares exactly apples for apples, but it's not as simple as that. So yeah, you come up with 3 broad terms and it basically covers the types of cover you're going to get. But as you mentioned earlier, every insurance company calls them something slightly different. So if you think of basic, intermediate or middle, and then the Rolls Royce.
The Rolls Royce. And if I was good at cars, which I'm not, we'd give a tier for each of those. We'd give a car that'd be appropriate. But if you're looking for a policy, try and put it into one of those. Is it a basic policy? Is it intermediate? Or is it comprehensive under the way I just described it? Because obviously there's going to be slight nuances of what you get. You need to know what you're going to get. To give you a cost difference, if you were going for a basic policy, so one that really only covers you for treatment, you normally on those basic ones have to be referred by the NHS as well, because you're not being diagnosed by the private hospitals. So that if there was no excess on that policy, that would be for a 35-year-old non-smoker, it would be £40. I know you said 30, it's £40. But if there was £100 excess, there would be £37 monthly premium. If you go for intermediate cover, so you go up a notch, with no excess, it's £60. So that's gone from 40 to 60. If you've got an excess of £100, you've gone from 37 to 54. And of course, if you go for the Rolls Royce, as Andy called it, then with no excess, that's £85 a month, which is obviously a lot of money. And you can pay an excess, so every time you claim, you'd actually have to fork out £100. In my example that I'm giving, that would bring it down to £71 a month. So, like all insurances, you can tailor it to fit your budget. Now, I know somebody in the industry who advises on private medical insurance, and what they do is they are in a fortunate enough position that they've got enough savings to think, look, do you know what? If I needed to go private, or my family did, then I would be willing to pay for some of the x-rays and bits and pieces that are probably going into the hundreds, early thousands in terms of pounds in cost. They would pay for that themselves out of savings. They're comfortable with that. They've got enough money. They're fortunate enough. But therefore, they're more worried about if they had something that was really expensive and they couldn't afford to pay for like a £50,000 worth of treatment for something very serious. They would want an insurance policy to cover that. So what they do is go much more down the basic level, go towards the lower level where they don't worry about the smaller amounts being covered. They'll pay a higher excess as well, and it brings the cost down. So those are potential benefits. So the cons of private medical insurance generally is that it is costly. I've just done the premiums, you can tell that. Not all conditions are covered, of course, and like I said, the chronic ones often are. Now, the underwriting on insurance there's different variations of underwriting. Now, you've got full underwriting, so that's where you've got the underwriters. So they're the people, the actuaries and the towers at these insurance companies look at you as a risk. They underwrite your health. They look at your questionnaires describing your health and your circumstances, and then they will judge whether they're going to cover you. It may mean they exclude certain conditions, but one thing about full underwriting is that you will definitely know what you're covered for and what you're not. So there's no grey area. It will also generally be cheaper than the other form of underwriting, which is something called moratorium underwriting, which is a lovely word, but I'm not quite sure where it comes from, but it means that you end up having a grace period. So normally what will happen is you won't be covered for pre-existing conditions for 5 years, but after 2 years of no ill effects, symptoms, or you've not had any treatment, then they will fall under that private medical insurance policy. So you suddenly will be covered. So it's basically a grace period where if your health improves, you're clean as a whistle, they'll go, yeah, do you know what? We'll cover you. So for people like me who have chronic conditions, that can work for you in your favour. But like I say, it's a bit more expensive than a normal fully underwritten policy. 2 other quick things to really bear in mind. There is something called continued underwriting, continued private health insurance, which basically means that you can take your existing underwriting levels from an existing policy you have if you move insurers and take it with you. And if you've got health insurance with a company as an employee and you go and leave that company, do bear in mind that you may be able to go and get a policy maybe with that company and turn it into a personal one. That's especially relevant if you've, for example, gone through a moratorium period or you've been underwritten. So do bear that in mind, because I know people in the past who've just left and gone, right, I'm left, they've retired, for example, and then they've decided, oh, I actually like that private medical insurance policy, I'll get one out. And suddenly the premiums are much higher and they hadn't realised because they've got no credit for what came before. Now, you may not realise this, and I hadn't quite appreciated it, but one of the sections of society where private medical cover is really popular is the over 60s. Now, they may not be working, they may have pensions, but you've got to think about it. They're quite willing to pay hundreds of pounds a month almost in premiums for their health insurance. I mean, they're not all going to be that. It depends on their circumstances. But the reason they will do that is because if you think about somebody who may be retired and has cleared their mortgage, their children aren't at home, they may not drive as much, they may not have a car, their outgoings may be greatly reduced. And so for people who are in that age group, I know it's a sweeping generalisation, but I've looked at the data, I've looked under the hood of this stuff at one of these insurers who deal with private medical insurance and advise on it, that they find that people of that particular age group are more aware of their own mortality and their health becomes their priority, because at that point you're just likely to have more things go wrong. So private medical insurance goes up the priority list, so they're more willing to pay for a premium. So in fact, it's not something just for young people. This is a product that very much becomes useful for people when they get older, because they don't want to be waiting on a trolley in a corridor in the NHS hospital round the corner.
And as you mentioned earlier, premiums on private health insurance, private medical insurance do increase each year, don't they?
Well, it's a good point to bring up, because it's slightly different to other insurances. So we have life insurance. You take out a policy, the premium's the same year on year, and you stay with that one insurer unless you choose to move and get a cheaper premium, for example. But with private medical insurance, what ends up happening is each year they write to you and tell you what your premium is going to be for the next year. So it's a natural break where you might decide to go elsewhere. So you become very aware that the costs do ratchet up and you might be able to rebroke, move elsewhere, which is very typical of that industry.
Good stuff. So if you want to know more about private medical insurance or private health insurance, we've got articles on the website, something I've been looking into very much in the last couple of weeks, and actually I'm really enjoying it. It's an interesting subject. Get onto the website and have a look.
Andy's turning into the health insurance over 50s guru on insurances. So yeah, you can always look at the articles or email him.
Okay, moving on to a slightly more somber theme over the next couple of pieces we're going to do. We're kind of talking of divorce and various different things. We're going to do the short piece first on a question you had from a friend of yours.
Yeah, so it was, as I mentioned in the intro, very simply, the couple were going through separation, were going to get divorced, but they had savings in an account that wasn't designated for the child. As they separated, they wanted to ensure that the money was going to be for their child's benefit in the future, but obviously there was a level of mistrust between the two ex-partners. They didn't want either one of them to have complete control. So the question was, what can I do, or what could they do with that money, that savings, to ensure their son benefited from it and the other partner didn't go off and blow it on a car or a new man or woman or whatever? And the answer is, well, there's a couple of options you've got here. Now, junior ISAs are good for this. Now, junior ISAs have a clause in them, a rule, that the money is the child's until they're 18. Now, there's a slight nuances. They can, in certain circumstances, get out just before, but it's due to ill health. We won't go down that part, but generally speaking, the money paid into a junior ISA is the child's, for the child's benefit, and they can access it at 18. I've always said that you're basically relying on the fact that your child is not going to turn into the next child from hell and going to be off doing things, because you can't stop it. Once the money's in the junior ISA, it's going to your child when they're 18, whether you like it or not. But of course, there is a benefit to that. So in this instance, if you put money into a junior ISA, so they had it in cash, they wanted to put it in the savings. Of course, you've got stocks and shares versions of junior ISAs, but if you put it into a cash one, then it means that money is definitely for the child. Each parent can't raid it. So once the money goes in, it's for the child. So that's a great solution. But of course, you can only put in £4,368 a year at the moment. It changes each year, but it's an allowance. So that was actually lower than the amount that they had for that child. So they could put some in there, and then they could wait till next year, the next tax year, and put some more money into the junior ISA just to protect the money, and it will grow. And the benefit of it, of course, it will grow tax-free as well. But the alternative is you could use savings accounts and use something called a bear trust. B-A-R-E, not B-E-A-R like the animal, but B-A-R-E. And it's a form of trust that gives the complete right to the money to the beneficiary. In that case, you'd put the beneficiary as the child, and that would enable the money to pass on to them, and each parent couldn't take it. So you could have trustees that maybe will be the parents, but it wouldn't be able to take the money out. It's the child's. So the only issue with that is you may involve using a solicitor to draw up the trust structure. So the account would be inside that trust. That can cost you money, and you're talking probably a few £100s. Alternatively, there are bank accounts out there that do allow to have two trustees on, like signatories on the account, as long as they've got parental responsibilities for the child, to be able to have the account, and they require both to agree for the money to be taken out of the account. Now, I mean, I'm not plugging the particular product because I just know this is one of them, but Nationwide have one. I think it's called a Future Saver, and that allows you to do that. So that is a particular product. Go and look at various different banks and building societies and check and ask them if the account can have two trustees' signatories on it, to have to both agree if money is to move. And some of those do have caveats. For example, the Nationwide one, you could, I think, only put 5,000 in a year, but you could get a nice Brucey bonus on the interest as long as one of the parents wasn't a Nationwide account customer already. So the positive message is that our solutions out there, junior ISAs, you can go and get trust drawn up, but they are expensive, and there are some accounts. And if anybody else, because there'll be lots of people who've gone through this, if you've got any other ideas or solutions out there I've overlooked, then do send them in, because it's a real nuanced area of personal finance. So do send them in.
Good. So moving on to the final piece, and we're talking about that dreaded word again, Brexit, and whether it will or won't happen, a no-deal Brexit. But specifically, we're going to look at Brexit, but from the point of view of your finances or investment.
Investment. So Brexit and your investments, in particular, no deal. Now, the first caveat I've got to say is that everyone talks about as if no deal's definitely going to happen. Now, we don't know it will do. It looks like Boris Johnson's hell-bent on it happening, or at least using it as a negotiating chip. So we will go down that road. We'll go as close as we probably can in order to force the European Union to do something and maybe agree some form of, what can we say, some sort of deal with the UK and whether we stay in. People are asking me, how do we prepare for a no-deal Brexit? Now, I am wary of doing it. I think trying to predict the future and investing on the back of that is always, you're always prone to be caught out, because you're making a lot of assumptions that something is going to happen, and it almost always ends up being sod's law, the opposite happens.
It's almost going down the route of being almost gambling, isn't it? Because you're gambling on an outcome.
You are. It's like crystal ball gazing. It's Nostradamus. It's all of those things wrapped up, and if you're not careful, you try and predict something, it won't happen. Let's be honest, go back to the Brexit referendum. Very few people predicted that we were going to even vote to leave, and so fund managers at that time were betting via their portfolios. They weren't gambling, they were positioning their portfolios largely on the assumption that we would remain in the European Union, and we didn't. And so lots of them got caught out, and they're still trying to play catch up in terms of performance based on the assumption or the guesswork that we were going to be still in the European Union. Of course, we're not. So this piece, I've got to answer the question though. I can't ignore it. So what I'm going to do is I'm going to tell people how I would have gone about answering a question like that. So the first thing I would do is think about, well, what would be impacted the most? And I would go and look at the period across the Brexit referendum. So go back to June in 2016. And now the referendum, I think it was on the 26th of June, 23rd, 26th of June in 2016. And it's such an obvious thing to see when you look at a performance chart of a fund. There's a big tick up normally if they were invested overseas. Go and look at the period from the beginning of June to the beginning of August. And that includes a period just before the referendum where markets were sort of getting a bit nervous. The immediate aftermath of the Brexit referendum result, where markets went completely bandy and everyone panicked. And then the days after, where people decided, hold on, this is what a no-deal Brexit could mean. And then when they eventually then settled down because they realised no deal wasn't going to happen anytime soon, it was still had years to go. If you look at assets over that period, how they performed between June 2016 and August 2016, you might get an insight, or you do get an insight, how they could possibly perform in a no-deal scenario that comes to happen in reality, because everyone was betting around that point. They were positioning themselves for a no deal. So there was lots of, we don't want to hold that particular asset. So they were bailing out things like the pound. Now, there's no guarantee it'll play out. We've never had a no deal before. We don't know how quite. But to give you an idea, the pound immediately after the Brexit referendum went from about $1.48 down to around $1.29. And so we had more than a 10% slump. Since then, we had more than a 20% slump in the dollar versus nearly every other currency, but particularly we had a nearly 20% slump in the pound versus most currencies, but particularly the dollar. So when you're investing, it's probably a fair assumption to think the pound is going to weaken. Now, there's a lot of weakness and bad news already baked into the value of the pound. The value of the pound is down to about $1.21. So how much lower could it go? Well, we're almost at the base level where we were after Brexit referendum, which means that there might not be much further to go. We might only go down to 120, 119. Some analysts are predicting we're going to go down to parity. So we're going to have $1 to £1. That sounds pretty Armageddon to me, but I don't know. I've got no crystal ball. I don't know what will happen. That just gives you some lines in the sand. So if we get weakness in the pound, further weakness, then what we would likely see is overseas assets rally. Any fund that was invested in America, Europe even, emerging markets. If you go and look between the June 2016 and August 2016, rank every sector, fund sector, by performance from top to bottom. It's amazing. It's incredible reading. So the top performing asset at that point was, in just 2 months, you would have made nearly 20% from emerging market. And that's not to say that will happen now, but if you go down the list, you can see that if you were invested in pretty much anything overseas equity-based, they made 10%. You're not necessarily going to make that now unless the pound collapses by the same level, because don't forget we were at 148, we went all the way down to 130, we big drops. Whereas now we're already really down towards the low end, 120. So if you get weakness in the pound as a result of a Brexit no deal, then you're going to see those overseas assets start to gain in value, get a currency kicker, which obviously you then got to bake in what those assets are doing on their own. So if you looked at all those equity markets, then yes, European markets they still performed well. You almost double-digit returns, but they were the weaker of the global market. So you think Japan, emerging markets, America, European equities were towards the bottom end of those winners. But that's, if you think about it, makes sense because Brexit involves not just the UK, but also the European Union. The area of bonds, now bonds did quite well because there's a panic bid. So people start becoming scared. They go rushing to safe assets. That means fixed income. So bonds, that means particularly government debt. So gilts did quite well. So they're the UK government bonds. You saw global bonds do better because global bonds also had a currency kick. So they were the flight to safety. People bought bonds, their price went up, but then you got the currency kicker from the devaluing pound. Interestingly, index-linked gilts, they did very well actually. Out of all the bond areas, so the bond sector, so you're thinking like global bonds, you're thinking about bonds in Europe, bonds in the UK, index-linked gilts did very well because they're index linked, which is meant to mean they got some form of inflation protection. If the pound falls, then that's inflationary because it means you import inflation from abroad because it means it's costing you more to import stuff. So we import a lot. So it means the value of the things we buy and the things in the shop will go up in value. So they rallied. But the one thing I would caveat is that index-linked gilts are a strange investment at the best of times. They're so volatile. 1 month they could be the top, 1 month they can be the bottom. So anybody who wades into them has to be, it's buyer beware. There's a lot of fund managers out there who don't particularly like them because it's a very difficult market to try and ascertain exactly how they will perform when you get a certain scenario. So I wouldn't particularly necessarily buy them personally, but gilts aren't quite as volatile. They're a little bit lower risk. Down the other end of the spectrum, what you've got to look at is the things that did badly. Of course, it didn't do badly, but cash, because you didn't get any currency kicker, but you didn't lose any money. But down the other end is smaller companies in the UK. Now, a weak pound is good for the FTSE 100. I've talked about it a lot on the podcast. But conversely, the smaller companies, so the FTSE 250 down, so you'll see UK small cap companies, they tend to derive most of their earnings from the UK. So they're very UK focused. So when the Brexit referendum result was announced, there was the idea that the economy would struggle, which would be bad for smaller companies in the UK. Therefore, their share prices would tumble, and therefore fund prices tumbled. And it was about the only sector where you lost money. Everywhere else, no matter what you did, you made money. And so it was almost the easiest time in the world to have made money was during the Brexit referendum, as long as you didn't hold UK smaller companies funds. And the other big one was UK property funds, direct property funds. So we're talking bricks and mortar. And if you recall, I did various podcasts on this, and go back to, I think it was podcast something like 168. There was a podcast I did in August last year. You can find it on the site. If you go onto moneytothemasses.com and search Brexit proof your portfolio, something around those words, you'll find an episode where I talk about this whole thing, about how I would Brexit proof in my portfolio. And it was very much centered on those property funds, because with people fearing the collapse of the property market in the UK because of Brexit, and I'm talking more about commercial properties, so businesses, they were selling out of those property funds and people got locked into them. Now, there's nothing to say that that won't happen again. So it's, again, buyer beware. That's why I don't hold them in my portfolio. But on the flip side of all of that, if we have the opposite, we suddenly get a deal, the pound rallies, everything I've just said basically works in reverse.
Yeah.
So it's one of those, which is why I think you don't try and plan for a particular scenario, because there's a lot of bad news already priced in. But I have to answer the question. Funny enough, I mentioned that past podcast. One thing I did learn is that I'm going to do the podcast today, and I thought, God, I feel like I've got a cold again. And I went back, and funny enough, that podcast was recorded in the exact same week this time last year, and I sounded exactly the same, almost like I wanted to cough or was about to lose my voice. So I think it might be hay fever. So I have got a timestamp of my voice over time, which most people don't, which maybe it's hay fever. Anyway.
Yeah. So put it in your diaries next year. Damien will have hay fever somewhere around the middle of August. Good stuff. I enjoyed that. So if you want to get in touch with Damien, you can do so in the usual ways. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with number 2. Get onto Instagram. We're doing lots on Instagram as always, but do go and visit our YouTube channel as well. We're doing loads of stuff on YouTube. In fact, you'll almost certainly see clips from this podcast featuring sometime in the future on YouTube, because we're actually recording this podcast as a video, and we'll select the best bits to go various pieces onto the website and onto YouTube as well. So you can see Damien delivering this.
Yeah, you can. And the other thing to mention is the midweek markets. We're doing a lot of stuff with midweek markets now that's on video exclusively. So backdrops, the things that I talk about that appear on screen to give things some context. So obviously it still works as a podcast. The aim is to work as a podcast, but do look at the YouTube videos of that, because you might find you prefer watching it rather than just purely listening to it. Finally, don't forget to put that date in your diary for the Money to the Masses event. So that is the 24th of September, which is a Tuesday. You've got nothing going on a Tuesday, 6:30 to 7:30. Come and support us. Like I said, you can find out more information at moneytothemasses.com/events.
And for those of you who did come and say hi to us on our Facebook chat on Monday between 12:30 and 1:30, thank you so much for doing so. We won't be doing it this week because Dave and I are having our well-earned rest, but we'll resurrect that when we come back in a couple of weeks.
We will do.
Until next time.
Until next time.